I see that it has been a great time for the Indian startup ecosystem to get the validation from the secondary market, the public listed equity market. I guess there has been an era of doubts where everybody thought that such companies would never make a mark on the listed front, only because of the kind of business model they operate at, right? And those are very very convincing, unconventional, and totally at a different orbit when we have to look at from the balance sheet point of view. But amazingly, this thesis of them not coming here was challenged and, of course, successfully broken when we saw successful listing of Zomato, Nykaa, and of course even Paytm, right? Because they successfully made a mark to the secondary market. Now, if you look at from the year point of view, almost 12 such companies, that's again non-conventional companies have actually came on the boards and managed to be there. And I believe this is something in sync with what has happened in the global markets. To again say that we have been riding the bull from the unlisted is also to be seen what is happening even in US, right? Almost like a $650 billion sort of money was raised in a single year, and we saw almost more than 500 unicorns itself got made in the 2021 itself only in US. So basically, what I'm trying to make a point here is that what we are looking at in India is a function of what is happening globally, and therefore I believe that going forward, this trend would certainly continue. Although there might be a pockets of valuation which are not very, I would say, convincing, and eventually, the function once the company gets listed, of course, depends on the demand and supply. So therefore, rather than looking at one or two odd cases, I would say we need to look at the broader consensus. And I guess market has accepted that. That is a good part for us.
Matki ji. I'm going to ask Debo some tough questions on valuation now. But, just a comment, Abhishek, on what you said on Indian markets, starting to mirror what has happened in more mature markets. I was reading prior to this panel that if you look at all tech in the US and then listed tech, it's about 15%, right? The internet stocks. And in India, that number is sub 2%. So if you look at the headroom for growth of listed equities that will start to come out of this India tech ecosystem, the headroom is really vast, right? And that's why, we've been amazed to see some very traditional investors start to pay a lot of attention, start to do the deep work, AMCs are doing almost private equity-like diligence on these companies to be ready with their thesis and their thoughts as they come and start accessing, the public markets in large numbers. And Debo, why don't you give us your thoughts on what is really the valuation framework to evaluate a large loss-making business?
Welcome again, ladies and gentlemen. With India coming up with so many unicorns in the recent past, investors have understood the importance of technology now more than ever. Technology has become the new necessity, especially in our new normal, where we are seamlessly organizing virtual events such as this. It is a given that technology will be ruling the markets in the years to come, and this is where most investors are keen on betting on it early. And this is possible through VC funding. But the sector in itself is huge, and investors should be very careful while picking up investable businesses, especially because startups don't have a financial history, but they might or might not have a growth potential, and understanding this growth potential is what is imperative. On that note, let's welcome our next panelists who are going to discuss the theme, what type of next-gen ventures in fintech, edtech, and consumer tech offer 10x return potential. Ladies and gentlemen, the very, very eminent panelists for this discussion are Mr. Abhishek Agarwal, Mr. Amit Ratanpal, and Mr. Debujyoti Ghosh, and Ms. Lavanya Ashok will be moderating this chat. Mr. Abhishek Agarwal, ladies and gentlemen, is a managing partner at Rockstud Capital LLP and has 12 plus years of experience in Indian financial markets. He has done his graduation from HR College and further pursued his MSc Finance from Lancaster University Management School in the United Kingdom. He started his career in PINC as a research analyst in the institutional desk. And after completing 2 years in the said organization, he joined his family-run stock broking firm, which was called Fortune Interfinance Limited. And he was in a pivotal position to set up entire Mumbai office operations, institution desk, and research and equities. He handled a team of 20 people at various divisions and roles, and his extensive knowledge helped him to advise and exchange his views on economy and stocks at various news channels as well, like CNBC Awaz, CNBC TV 18, ET Now, NDTV Profit, and Z News. He successfully formed SEBI-registered VC fund Rockstud Capital Investment Fund in September 2018 with a target corpus of $25 million. Now we have with us Mr. Amit Ratanpal, the founder and MD at Blink Invest. He comes armed with over 20 years of experience across private equity, capital markets, asset management, and investment banking. And other than that, he has been instrumental in setting up various domestic and global funds and has really invested and managed 300 crore rupees across 21 companies, out of which 6 companies have achieved exit till date. Now, he has been on the advisory board and investment committee of various funds. At ICICI, Mr. Ratanpal set up and led the private equity fund of funds businesses and was an integral part of the international banking group. At Birla Sun Life, he was part of the Treasury Solutions team and led the e-broking network. And he's a chartered accountant, holds an executive MBA from Narsi Monji Institute of Management Studies, and has completed the general management program from Harvard Business School. Now we have with us Mr. Debujyoti Ghosh, who is the fund manager at Axis AMC. He has more than 13 years of experience in private equity investments in India, and he has full cycle deal experience driving key decision-making around investments, exits, and portfolio management strategy. Prior to joining Axis AMC, Mr. Ghosh was heading the India investments of BCP Bear Capital, and he performed complete fund management role in BCP, including sourcing, evaluation, negotiation, portfolio management, and exits, focusing on early stage investments. Prior to that, he was a part of the Standard Chartered private equity team in India, focusing on growth capital investments, and he completed multiple investments and exits in different sectors, including consumer, manufacturing, media, construction, services, etc. In his current role, he is primarily responsible for growing the unlisted investments platform at Axis Asset Management, focusing on high growth opportunities. He is an MBA from IIM Calcutta and BE in Information Technology from Jadavpur University. Now, this session, ladies and gentlemen, will be moderated by Ms. Lavanya Ashok, who is a partner at Trifecta Capital and leads Trifecta's late-stage equity investing business. Prior to joining Trifecta, she was managing director, private equity at Goldman Sachs and Company, and she joined GS as an analyst in 2004 in New York and rejoined the firm in Mumbai in 2010. Across these stints, she has spent over 12 and a half years with the firm. So, ladies and gentlemen, as you can see, this is a stellar lineup. I'm going to extend a very warm welcome to Mr. Abhishek Agarwal, Mr. Amit Ratanpal, and Mr. Debujyoti Ghosh, and Ms. Lavanya Ashok, who's our moderator. So, ma'am, it's now over to you. Ms. Lavanya, take it away.
Thank you so much, Aishwarya. Big pleasure to be here with these 3 wonderful investors. Maybe we'll start, as we sometimes do at the beginning, with Amit, who is a very early stage investor. Amit, would be lovely to get your vantage point. What types of companies are you seeing in terms of, investor interest now? And what is the appropriate hold period and return expectation for those who are looking to come in at the early stage?
Thank you, Lavanya. At Blink Invest, we only invest into 2 sectors, that is tech and fintech. And what we realized that, from a philosophy perspective, that we love to build businesses. So we work very closely with the founders, and almost we call ourselves as co-founders, along with the company's founders as well. So our sweet spot for making investments is a pre-series A, which basically means that the company has got a team in place, they've got a product in place, and early tractions are there. And early traction could be, either the consumer acquisition strategy or a go-to-market strategy is ready. There's a proof that people are liking it. There is some revenue also coming in, and this is the time when we get into the companies. barring the last couple of years when the valuation is obviously up the roof, us, a sweet spot of as such making investment is between 40 to about, let's say, 100 odd crores. That's a sweet spot we would like to make investments. And whenever we discuss internally, we say, hey, this has to be a wide space, which is $1 billion revenue opportunity. We don't mind being the first mover advantage. And if you look at some of the companies in the past, as we had made investments, example like Imaticus Learning, when we invested in 2015, people were not talking about boot camps. People were not talking about placements driven courses, but we were the first investors. And from the time of our investment, the companies had grown 20x in terms of revenue in just about 4 to 5 years, and with a very little capital, which is 1/5 of the capital against the revenue. And this is the types of growth of the companies which we would like to invest, which is a wide space. And we don't mind creating that wide space as well. And that's the lens which we look at it. And typically our holding period is about 4 to 5 years, because we believe that the time when we invest about, let's say, 10 to 15 crores in a particular company, that's the time, since they've got early traction, they have to build the org. It could be, sales, it could be distribution, it could be finance, it could be even technology and other parts of it. And that's the time when we spend a lot of time with the founders. In fact, we do come out with a very specific, clear 100 days plan. And as we are building this particular company, for 2 years, our focus is that the money should last to build the company to achieve the next level growth. And that's the time the company will typically go between 18 months to 24 months for a Series A. And we do participate with the company in Series A as well, because we know that this company is doing well and this is the time to really double down on this investments. And by the time it moves to Series C, which is generally between 4 to 5 years, we would exit the company. And hopefully by that time, we would look at a conservative basis between 5 to 6 times multiple return. And my experience, at least we have seen in the past when we invested into few companies, for example, a Blink One had a portfolio of about 4 companies, 3 we got exit, none of them, really did bad. In fact, most of the companies had delivered a 4 times multiple return. So a concentrated portfolio, working very closely with the founding team members, really works well for us.
That's wonderful. And I think the key takeaways are very large TAM, very good team, and you act almost like a co-founder or founding partner in growing the team, growing the org, and finding that product market fit. So that's great. Debu, maybe we can move to you, given you are a more mature growth stage and beyond investor. Would love to get, what interesting trends you are seeing, and where is the strong return generation potential in the stage at which you come into some of these wonderful companies?
Sure. So first of all, hello everyone, and thanks Lavanya for the question. So the way we approach it at Axis AIF is that today, if we look at the market, there has been some key structural shifts which has already happened as compared to what we used to see, say, 5-7 years back. There were a lot of unanswered questions. Whether the digital economy is going to grow or not, whether some of these new business models, they are going to be sustainable or not, and similar sort of apprehensions around the new age business space that we see today. But I think most of those questions today have been answered pretty decisively. And the increasing proportion of contribution of digital economy as a proportion of the overall economy, it's growing, and it's an irreversible process. And we do firmly believe that it's only going to gain pace. So we are a sector agnostic fund essentially, and we like to keep ourselves flexible. If we look at the overall segment, the new age business space, be it fintech, be it edtech, consumer tech, and within these segments, I mean, these are very broad terms. People generally use fintech, but if we look at fintech, within the fintech, there are sub-segments. There's payments companies, there's BNPL players, there's insurtech. There are various kinds of segments that we see. Similarly, in edtech also, we can look at K-12, there's post-K-12. Within K-12, there are sub-segments as well. There's test prep, there's skill development. So each of these subsegments also have different nuances. What we are seeing today is that as compared to 5 years back, a lot of these business models have gained a certain size and scale. So it now offers a very different risk return profile. And today, the fastest growing segment is the new age business segment. So if I'm a growth investor today, I cannot ignore this space anymore. And the fact that this has happened over a pretty short period of time has also answered the question whether these business models are sustainable or not. And that's why we are seeing a fair amount of investor interest also coming in. So far, this space used to be dominated by the overseas funds and overseas investors. But increasingly over the last 3 years or so, we are seeing more and more domestic investors are warming up to it. And they are coming in good numbers. And that's what we see with the rise of the AIFs. And quite rightly so, because what has happened is that today, if we have to take part in this space, then the choices are limited if you are only looking at the listed space. Although the listed market is also becoming a lot more matured and evolved and taking a shine to these business segments. But essentially, it's more dominated by the unlisted businesses, and that they have grown to a certain size and scale, which actually offers a decent risk return profile. And that's where we want to sort of keep our focus on. So in more sort of, depending on the risk appetite of the investors, they can either choose to get into early stage, or they can now look at some of these businesses where we participate in a slightly later growth stage, beyond Series C or beyond Series D. And then there's maybe 2-3 years away from the IPO. And there's a fair amount of growth prospect there. In terms of risk profile also, they probably are better placed than some of the small cap or mid cap companies on the listed side. So that apprehension has gone away to a large extent.
Absolutely. And Debo, thank you for validating my career choice. It's exactly for the reasons you mentioned that I joined Trifecta to start a tech-focused growth fund, because we're seeing incredible success from the early stage investing activity that Amit and Abhishek and many other VCs are doing. And so as these startups mature into that Series CD, more and more capital will be needed to continue to support their growth. And, we are one among many players in that ecosystem. And Abhishek, maybe moving to you, you have a very unique barbell strategy, right? At the one end, you go very early, almost, pre-Series A and mentor companies. On the other hand, you're also a seasoned public markets investor. Maybe it would be lovely to get your thoughts on the listed tech universe. There's been lots of activity there. Some have done really well. Some have received a poorer reception. Would be wonderful if you could come in here, Abhishek.
Hi, Lavanya. So, it really gives me an amazing opportunity when we have to look at both the ends, right? As you rightly mentioned, that we are looking both at a very, very early stage at pre-A. And then, of course, being a hybrid strategy fund, we also do invest in listed equities in the secondary market. Coming back to your question, I see that it has been a great time for the Indian startup ecosystem to get the validation from the secondary market, the public listed equity market. I guess there has been an era of doubts where everybody thought that such companies would never make a mark on the listed front, only because of the kind of business model they operate at, right? And those are very, very unconvincing, unconventional, and totally at a different orbit when we have to look at from the balance sheet point of view. But amazingly, this thesis of them not coming here was challenged and of course successfully broken when we saw successful listing of Zomato, Nykaa, and of course even Paytm, right? Because they successfully made a mark to the secondary market. Now, if you look at from the year point of view, almost 12 such companies, that's again non-conventional companies have actually came on the boards and managed to be there. And I believe this is something in sync with what has happened in the global markets. To again say that we have been riding the bull from the unlisted is also to be seen what is happening even in US, right? Almost like a $650 billion sort of money was raised in a single year, and we saw almost more than 500 unicorns itself got made in the 2021 itself only in US. So basically, what I'm trying to make a point here is that what we are looking at in India is a function of what is happening globally, and therefore I believe that going forward, this trend would certainly continue. Although there might be a pockets of valuation which are not very, I would say, convincing, and eventually, the function once the company gets listed, of course, depends on the demand and supply. So therefore, rather than looking at one or two odd cases, I would say we need to look at the broader consensus, and I guess market has accepted that. That is a good part for us.
Matki ji. I'm going to ask Debo some tough questions on valuation now. But, just a comment, Abhishek, on what you said on Indian markets, starting to mirror what has happened in more mature markets. I was reading prior to this panel that if you look at all tech in the US and then listed tech, it's about 15%, right? The internet stocks. And in India, that number is sub 2%. So if you look at the headroom for growth of listed equities that will start to come out of this India tech ecosystem, the headroom is really vast, right? And that's why, we've been amazed to see some very traditional investors start to pay a lot of attention, start to do the deep work, doing AMCs are doing almost private equity like diligence on these companies to be ready with their thesis and their thoughts as they come and start accessing, the public markets in large numbers. And Debo, why don't you give us your thoughts on what is really the valuation framework to evaluate a large loss-making business?
Right. So I actually love the valuation discussion. It's the most often discussed point. On a serious note, when we look at these businesses, honestly speaking, there's no cookie cutter model for valuation. Or valuing these very different kinds of businesses. There are B2C businesses, there's B2B2C businesses, there are B2B businesses which have come up. So essentially, it's very difficult to put everything in one particular model. Having said that, there are different approaches. Obviously, we try to triangulate by looking at the valuation from different angles. Whether it is GMB multiple, revenue multiple, or other ways also. In some cases, we do, we have enough number of comparables in the overseas markets. So that also sometimes provides some indication. But the broader point in terms of valuation that I'd like to make is that a lot of these companies, and particularly the space where we focus on slightly more mature, evolved business models, is that if you look at the unit economics rather than the overall P&L or the bottom line only, if you look at the business model and the unit economics, a lot of these businesses are actually making money at that unit economics level. The business model has got established. And they are making a decent margin at the contribution margin levels, be it CM1, CM2, whichever way you look at. And the fact of the matter is some of these large businesses actually has sort of achieved that critical mass that today, if they stop growing and stop spending money for growth, what we call the cash burn, will pretty quickly go away and they'll immediately start throwing up a lot of cash. But the fact still remains that there's so much growth potential for these companies that they keep on spending and acquire more and more market share. And there's a fair amount of headroom, as you mentioned also, to grow these businesses to much larger levels. So that's where the real spend is happening. It's what we are seeing, which is a fair thing. And I think the key point is the listed market investors who are more traditional in nature, they are also warming up and realizing this fact that just because today the bottom line is showing a loss doesn't really mean that the business model is flawed. There are deeper reasons and very attractive opportunities which these business models and these larger companies are presenting today. So to that extent, our valuation approach is more nuanced, and we do take a much deeper look at it.
No, great points. And Amit, maybe, as our resident fintech expert, we are going to come to you now. technology is changing so many things, right? The way we invest, the way we pay, the way we store money even. So can you tell us what your views are? I know fintech is a large sector. If you read reports, they'll say 50, 60 billion. But where are you seeing huge opportunity? What are the breakthroughs that you're excited about? Would love your views.
Let me give you a little background, why and fintech has been a very interesting sector, not only for India, but across the globe. And if you see the last 5 years trend, across the globe, which is US, India, UK, and some of the markets, fintech almost has been 20 to 25% of VC or PE investments in general. So it's been really one of the most attractive sector. And the reason is because it cuts across all industries. It cuts across all individuals, it cuts across SMEs, large corporates, and across the board. And today, as we look at fintech, we can divide into different ways. One, if you look at from a consumer, which is an individual perspective, their opportunity, which we believe lies, is mainly on the micro investments. Because today what is happening is that, specifically in India, it's a very, very large population. And it's spread across geographies, and there is a different income strata, and there are different requirements. So what we are seeing is there are companies which says that, okay, if you have as low as 100 rupees, you can also invest in gold, and which is a digital gold.
Absolutely.
If you go to high net worth individuals and family offices, then the opportunity which we would be available to them is cryptocurrencies and alternative asset class and across the board, right? So that's how we're looking at the consumer side. But when we look at MSME, SME, and everywhere, I think it started with a very simple solution of everyone needed a very simpler payment solution.
Absolutely.
Because that's what people started at, rather than logging with the bank. And that's where we see there are different payment apps for individuals and different payment apps for SME. And over a period of time, they moved to one of the biggest requirement is your SME gap is the working capital requirement or the credit gap. Is the second part which we found the people are moving. And the third, they're actually getting into the business by saying that, hey, can I make your life easier by giving you account receivable solutions or a payable solutions, or even the world is moving towards a super app. So we believe that if we look at per se SME, payment is still obviously underpenetrated. We'll see a lot of penetration still happening there, but real money ultimately will be made either from lending business, insurance business, or providing a super app, which is an end-to-end solution, right from receivable, payable, stock, and making their life easy. That's how we're looking at the SME solution. And when we look at individual, which is a consumer, now obviously consumer will be divided into multiple levels. One could be your millennials, one could be your freelancers, and across the board. And we believe that there would be neobanks which will again look at different solutions which cater to only their specific requirements. So for example, if you look at freelancer, quite a bit of their money would be remitted from overseas, and they are not someone who is very equipped with the compliance, tax, and a lot of other things. So there will be an app which says, okay, not only are making your remittance easy, but even savings and investment, but also ensuring that you are tax compliance with very easy to use software. So that's one way to look at it, where the opportunity lies. But if you look at from an industry segment of fintech, we believe, and this is the report which we recently came out on fintech, which was widely covered by CNBC and other Economic Times and other media as well. Payment as a system, as a particular industry, we believe it's mature. And that will always be a good and interesting hook for customer acquisition because everyone needs it. And lately, what we found is that most of the banks, specifically not the top 2-3 banks, but the cooperative banks and the small finance banks, never had a as per se payment solution, and they realized that the payment company are actually becoming their competitor because not only they're taking away their clients, but also started giving them lending into the business. So we have seen a lot of white solution being provided to some of these banks. So that's one opportunity which we believe is there. If we look at lending, I think India is still extremely underpenetrated, but the key question comes when it talks about lending is, what is the unique acquisition strategy? Because the cost of acquisition is always going to be very expensive in India. And the second is how much you can digitize so that it's easy to give them a loan at the minimal information or underwriting them. And that's the time when we believe that supply chain finance is a very, very interesting area. We find a very large opportunity there. And as you would see, the UK, the supply chain market is almost 30% of the world credit market. India is not only even 2 to 3%. So we believe supply chain is again a very, very large market. The wealth and asset management is, again, as I mentioned to you earlier, is a very, very interesting space. And we believe that a lot of things will be done in India. I meant to say today, still, most of the Indians are parking their money into fixed deposits or savings accounts. And today it's not even, forget about inflation, it's negative, So we believe most of this money will move to, investments. And what we have seen is that per se globally, we have seen, if I compare with India, most of the Indians have been, saving their money in gold or real estate. So that's the place where we believe that micro gold or micro investments into real estate will be the starting point, and then eventually they will diversify into mutual funds and other portfolios. So again, that's an area where we believe a very, very large opportunity is there. Insurtech, again, we had come out with a report on Insurtech. We made our investments also. Now, whether we talk about health insurance, with the wellness ecosystem, so that people become more and more healthier to reduce the claim ratio, or merely that, hey, I'm a SME or even a MSME, can you give me at a one click what is a simple solution I should buy as insurance which would cover my fire and your basic needs or stock requirements or working capital loss? I think that's again are two areas in the insurance piece which we love a lot and believe quite a bit happening. And the last piece which we believe on the banking infrastructure, most of the banks have been working on a very, very traditional software.
Correct.
And that's an area where we're seeing a plug-in software ranging from compliance, KYC requirement or streamlining this to digitizing the processes or system. And it could be as simple as, hey, your underwriting system, which you've been doing it for a while, but now this needs a lot of automation to that extent. So we believe that, again, there is quite a bit of opportunity where the bank will, and we all have seen that most of the banks have opened themselves up, specifically in terms of providing the API or partnering with the startups. And that's an area we believe a lot of business would be getting created by providing a very bespoke, specific solution, but it's large enough for a bank to look at it and even to not only to provide into India, but across the globe. So these are the sub areas within the fintech, which we believe a very, very large opportunity will come. And recently, as you know, that the government has made the first movement to at least start taxing the digital currency. So, I think that is again a very, very interesting aspect of it. That is going to be a reality in the times to come. And we will see a lot of changes happening on that area as well. But by and large, we see that every pocket, if you pick up, whether it is real estate investments, whether it is mutual fund investment, the entire role out there is a digitization. But at the same time, it started with giving one simple solution, a bespoke solution, and things are moving that rather than giving one specific solution, can I give them a value chain solution or end-to-end solution? And I believe that's where the future is going to in the fintech world as well.
Lovely. Abhishek, would love to have you come in here on broader consumer internet trends and where you think the interesting 10x return potential opportunities are, because we are crystal ball gazing on this panel. And then Debu, I'll request you to come in on EdTech quickly after that as well.
So, from the product side, I mean, I guess India is still lagging behind in terms of really creating, such products which are, exportable or, acceptable at global level. I think so. Predominantly, we have been our software, experts, and that also comes from the legacy of, our past, which is Infosys and TCS. Actually, managed to get into that business, and therefore, whoever is coming out from that, Nexus and the new age entrepreneurs are predominantly looking at SaaS business as a major place, and that also has taken its own sweet time in terms of evolving. And today, it seems that almost all possible companies in whatever domain do come out with some kind of SaaS sort of product to sell, right? Whether in the form of membership or in form of real software as a service. From the return point of view, 10x or more than that, I guess that's a function of also depending at what stage you are coming and investing, right? For example, where we come at pre-A, we typically look at exiting around Series B or if we are lucky, maybe Series C, right? The IPO market, etc., comes almost after Series E or onwards. So therefore, if one has to look at from that point, and we have done our own staging exercise. So from that angle, an investor coming at a pre-A to Series B, one can look at if all things goes as per plan. One can actually look at multiples of upwards of 20 to 30 times, right? Of course, those keep changing depending on the market also, right now. As Debu also pointed out, that's extremely becoming difficult to identify good opportunities and also, seeing that kind of upside. So I believe it's a sign of a maturity. and therefore, it is not that easy to actually identify such a huge outlier anymore. I guess you would be more luckier if that really survives and really become a business. Eventually to be either get listed or to be sold to the next rounds. So this would be my small bit of thoughts here.
Lovely. Debo, what about your views on EdTech?
Yeah. So on EdTech, I think broadly, we have just about started seeing the growth and the capital flow. In the way I see it, EdTech has been lagging a bit in terms of attracting the right amount of capital, which I think has started changing from 2020 onwards. This is too large a space to be ignored, frankly, and there are obviously different segments. Generally, if we divide it into K-12 and post K-12, typically so far what we have seen is the maximum sort of focus has been on K-12, and post K-12 is just starting up. But even within K-12, there are, we can further segment it, say, for example, from 1st to 5th standard, 6th to 8th standard, and thereafter 8th to 12th standard, and then competitive exams, preparations, and all those things. So clearly, there is a huge potential. I mean, today we have seen the EdTech users in the K-12 segment probably growing from 25 million to 100 million users over the last couple of years. But there's a lot more to happen over the next few years because the potential is huge. We're talking about 300, 400 million sort of students who can benefit from that. But my personal take is that post K-12 will probably start catching up now. And we have already seen unicorns coming up from the post K-12 segment as well. There are two key factors which drive post K-12. One is that there's a huge need for upskilling. And upskilling is not a one-time phenomenon or not a single point event for a working profession. So it can be a sort of every 2 to 3 year, you may need to upskill yourself. And that's where the job market is also sort of trending. If we look at some of the studies, there's a peculiar pattern that we observe, that there's a lot of engineers, etc., graduates who are coming in, who are coming out of the colleges, but everyone is not getting employment because the level of skill that is required by the industry is not being met. So there's a clear gap between what is being taught in the traditional institutions and what is required by the industry. And this is increasingly becoming apparent because of the advancement in the tech. The traditional institutions are not always being able to keep pace with that. So this gap is being met by the post K-12 edtech companies. And the more modular this whole approach becomes, that you don't need to have a full degree. You can focus on certain subjects, certain specific aspects within a subject. And that's the clear trend that we are seeing. The other key driver is that for the overseas education, there's a huge demand. And today, some of these edtech, post K-12 edtech companies are offering that opportunity, maybe not entirely, but at least in a blended model, to access those overseas institutions at a much less cost, I mean, at a fraction of the cost. And on the other side of that also, for these large institutions, overseas institutions, these edtech companies are basically offering them the India market or at times the Asia market also. So it's a win-win situation for both these, sort of participants, which augurs well for the growth of this post K-12 space. So I think there's a lot to happen in the post K-12 as well going forward.
Understood. No, this has been wonderful chatting with all of you. One quick parting thought for our participants from each of you, and then I will wrap.
Sure.
Maybe Debo, you can go first.
Sure. So I think overall, what we are seeing in the new age business space is tremendous growth happening, and going forward over the next 10 years or so, at least that's what I believe. This will continue to grow, and if at all, it will further gain pace. And now it's becoming so large, as I mentioned earlier, it's very difficult for a growth investor to ignore this space anymore. And increasing domestic participation is something which is really a good sign, we believe, because there's an increasing participation by the Indian investor vis-a-vis the overseas investor, which used to dominate this space, but now the AIFs have carved out a space for themselves. So that will help eventually in the listing process as well, because the AMCs take a lot more comfort with many of these new age business models now. And the listed market evolution also will help to get some of these companies listed, many more of these companies listed, and eventually provide the necessary returns to the investors. That's my overall take on this.
Lovely. So AIFs like us are building for Bharat as well, and for Bharat investors. Abhishek, maybe you next, and then Amit, parting words from you.
So I believe it's a great time, and most importantly for India, if we look at the acceptance now from the Indian investors, this has been now quite large. We can look at from the VC funding, or even the family offices actually putting money into the VC funds, and that is hitting record numbers, as we have already seen last couple of months, the announcements, including yours. So it shows a belief. It shows a belief that this now is considered to be an asset class, which people were shying away only because of the model, which they were not fully convinced on. But I believe that this is where the world is today, and is nowhere going back. Therefore, for us, it's an amazing time, and for startups to really do something, because the ecosystem or the tech infrastructure is now available. Now that is very important, right? Idea uniqueness is one thing, but if you don't have the right infra, right connectivity, you simply can't build a business model. So in the last 10 years, I think so we have really made a huge jump in terms of progress as a country, and the next 10 years would be much faster in terms of what we are going to see as a reality of some things which are still looking as if it is going to happen next 20 years. I think so that journey would happen much faster than anywhere else in the world.
Lovely. Amit?
Yeah. So, from a HNI investor perspective, I think, traditionally most of us would have looked at real estate, gold, or even public markets. I think that a must allocation to the private equity VC space is there, because this is going to be a long-term opportunity, and think that VC and private equity is nothing else but like building your own businesses, right? Because when you would have gone and had a cup of tea at the Kirana shop or a shop near your place, and suddenly you realize, oh, from 10 people in 2 years, there are thousands of people want to just have that tea. And you said, oh, this guy has now worth 10 lakhs or 20 lakhs. And this is how the business have been built of quality. So, and this is where the startup world or a VC world or a PE world comes in and say they are building business, making the unorganized sector into more organized sector. And this is where the reforms are happening. So from a HNI investor's perspective, I think it's a must allocation, depending on the risk appetite. If I look at from an entrepreneur perspective, yes, it's the best time to be an entrepreneur, because a lot of money is chasing good quality companies. At the same time, my only word to all of them would be that, hey, while you're doing this business building and everything is great, focus on revenue, focus on your go-to-marketing strategy, because these are two extremely important pieces. If you don't have go-to-marketing strategy, if you don't have a revenue, cash flow, and then ultimately the profit, the business long-term sustainability would always be a question.
Absolutely. Amit, from your lips to the ears of all the capital allocators that may be listening, and the entrepreneurs as well. Thank you so much, Amit, Abhishek, and Debo, for a wonderful panel.